Another mistake we make as e-commerce business owners is that we tend to neglect doing the digital marketing math. Dum dum dum. Hey guys, welcome to another episode of Common E-commerce Mistakes. In this episode, we are going to unpack the fact that we tend to neglect doing the much needed digital marketing math when it comes to our businesses, our online businesses specifically. Now, what we're going to unpack today is just a couple of calculations, formulas, if you will, that is going to give us an indication of what we can actually afford to spend on our marketing and what expectations we can set for ourselves when it comes to actually making our money back. And that is what we're going to look at today. Cool. So at the end of the day, let's, for argument's sake, say that we are selling jeans and the jeans retail for $500. And all the way over here, we have our business. Our business is currently selling jeans at 500 Rand, and it's called the Jean Company. Now, the Jean Company, we have to advertise, and we're going to advertise on a platform like Facebook. And let's say we have 5,000 Rand a month available for ads. We're going to have to pay Facebook 5,000 Rand and hope that we get what? Clicks. Okay, so clicks, people need to click on our ads in order to go where? To our website. And then what do we do on the site? We hope that they convert into customers, which essentially would then be buying the 500 Rand worth of jeans. Now, every time someone clicks on an ad, there's a cost attached to that. Let's, for example, say that cost is 5 Rand. That means for a 5,000 Rand investment, we're going to get what? What is 5,000 divided by 5? It is 1,000 clicks. Now, the average website, guys, has a conversion rate of roughly 1%. That means that 1 out of every 100 customers are going to convert. Not every single customer that walks into the store in a retail arena or retail scenery is going to convert. People come in, they check the product, and people ask, "Can I help you?" You go, "No, I'm just browsing." You walk out, you didn't buy anything. Now, the same is true for the online realm, but the reality is it's so much easier to browse. It's so much easier to click on an ad, browse, and then jump off. So the amount of people that convert online is a lot less than the amount of people that convert in store. So roughly 1% of people convert online. That means that for 1,000 clicks, we would have gotten, if 10% would be 100, 1% would be 10 sales. Cool. Now 10 sales times 500 is what? It's 5,000 Rand. So technically we would have spent 5,000 Rand on ads and we would have made 5,000 Rand back. So as a business owner, you're thinking, hey, cool, I'm actually breaking even. That's really good. I'm getting free advertising to some extent and people are buying the product. And it's actually not bad. In our first month, we're breaking even. That's ideally what more than anybody can ask for. But the reality is, guys, you're not actually breaking even. And that's why the digital marketing math is so important. And let me quickly explain this to you. You see, the 5,000 Rand you've made back, a lot of people would claim that is your ROI. But that is not the case. It's not your return on investment. That is called your return on ad spend, your ROAS. Now, the AS stands for ad spend, return on ad spend. In order to really get an idea of what you're making back from an investment perspective, you're going to have to do a few more calculations. Let me explain. So we have our pair of jeans. Our jeans are $500 each. And we sold 10 of them last month, which equals 5,000 Rand. But what a lot of marketers specifically tend to forget is that it costs money in order to manufacture these jeans. And the cost of that specifically needs to be factored in when we want to work out what we've made back. Let's, for example, say that our jeans are $300. That then means that the difference between these two is 200 Rand. So we're actually making 200 Rand gross profit every time we sell a pair of jeans. So 10 times 200 equals 2,000. So we made back 2,000 Rand gross profit. Now, this is where things get interesting because we actually didn't make that money back. we actually ran at a loss. And here's why. We spent 5,000 Rand on ads, and we also spent 3,000 Rand to manufacture the product, because that is 300 times 10, the cost of the product, $300 times 10 jeans that we technically sold. That means that our total cost so far is 8,000 Rand. And if you remember, our ROAS was 5,000 Rand. So we've only we actually ran at a loss here. So that is essentially what we in the minus here. We spent 5,000 Rand on ads, and we also spent 3,000 Rand to manufacture the product, and we only made 5,000 Rand back. That means that we're at a deficit of minus 3,000 Rand. So every month we're actually running at a 3,000 Rand loss, which is obviously really important to know, because if you want to grow a business, you need to be able to understand what money is actually going into the bank, if money is actually going into the bank, and what percentage of the money that you invest is coming back into the bank. We can see here that we are actually running at a loss every single month. Now, this also excludes, keep in mind that this also excludes stuff like warehouse, staff, shipping, depending if you're charging people. So this gives us a much deeper perspective on what's actually needed from a marketing perspective in order to generate a real positive return. Now, the reality is, when it comes to an e-commerce business, you're not going to generate the return if you're a brand new business, from day one. It just doesn't work like that. Or the chances are very slim that that's going to happen. But this, at the end of the day, at least gives you an idea of what you're in for. If you're going to be spending 5,000 Rand a month on ads, if you are going to get 5 Rand a click, if you are going to drive 1,000 people to the site and get 1% of them to buy from you, you're going to get 10 sales, you're going to get 5,000 Rand back. So in essence, if you can't find a way to improve the gross margin of the product, you're going to have to find a way to drive traffic at a cheaper price or get innovative with your traffic. And there are different ways to do that, and it's something we can unpack in another series of videos. Another common mistake that we make as e-commerce business owners, and that is that we don't really work out what we can afford to invest when it comes to acquiring a customer, and what is the lifetime value of that customer. Okay, let's just create a bit of a section over here where we can think clearly. So we can see that we need 100 visitors in order to make one sale. Okay, now we can see here that it's costing us 5 Rand a click. So that means that the cost of acquisition is already $500. So that is our CPA, cost per acquisition. But our true cost of acquisition is also plus what it cost us to make this pair of jeans. As per the previous slide, that was $300. So the true cost is 800 Rand to get a customer. And that's something that we can take with us in the next video, which I will explain on how to work out your lifetime value and the profitability of that actual customer as well. To conclude, at the end of the day, as a business owner, especially if you're starting out, it's really important to do these calculations, because it's going to give you an idea of what is needed in order to make this profitable for you down the line, and we'll unpack that in the next video. From our side, I hope that you guys enjoyed the video. I hope you've gotten value out of it, and we'll see you next time.